One of the crypto market's standout features is the fact that it trades 24/7, 365 days a year. Meanwhile, sleepy old TradFi clocks off for the weekend on Friday afternoon and doesn't power up again until Sunday evening. Well, the world's largest derivatives exchange has decided to change this, and its impending pivot to round-the-clock trading is set to have massive consequences for all crypto degens. My name is DC, and you're watching the Coin Bureau. The CME Group is a TradFi behemoth boasting a market capitalization of $108.59 billion and generating over $6.5 billion in annual revenue. They operate as a systematically important financial institution that handles the vast majority of regulated institutional derivatives trading within the United States. In 2025, this single exchange processed a cool $3 trillion in crypto notional volume across their futures and options product. To put that sum into proper perspective, the CME's average daily volume surged by 139% year over year to reach 278,000 contracts per day. This represents approximately $12 billion in daily notional value flowing entirely through regulated TradFi channels. However, despite handling this astronomical level of digital asset liquidity, the exchange has historically operated on a distinctly antiquated schedule. Their cryptocurrency futures currently halt trading every Friday afternoon, precisely 4 p.m. Central Time, and remain completely dark until Sunday evening at 5 p.m. Central Time. This weekend blackout window creates a massive structural vulnerability for any institutional investor holding active derivatives positions. But starting on May 29, 2026, this century-old legacy scheduling is going to be permanently dismantled. The exchange has officially announced that their entire suite of cryptocurrencies futures and options will transition to a continuous 24/7 trading schedule on the CME Globex platform. And this operational shift effectively eliminates the most infamous technical artifact in the entire digital asset industry. You see, for years, retail traders and institutional algorithms alike have obsessively tracked the phenomenon widely known as the CME Gap. Because the traditional exchange closes on Friday while the underlying spot markets continue trading throughout the weekend, a price discrepancy inevitably forms when the futures market finally reopens Sunday evening. This discrepancy creates a zone of unfilled institutional orders that the market statistically gravitates back toward as large players seek to re-establish their misaligned positions. Historical data confirms that these specific price gaps are eventually filled approximately 77% of the time. This historical 3/4 probability turned the gap into a magnetic price target that heavily influenced short-term trading strategies across the entire ecosystem. The psychological impact of these weekend blackout periods was most pronounced during high volatility events when geopolitical news or macroeconomic data dropped while the institutional venue was completely offline. Institutional hedgers were consistently forced to endure severe basis risk during these weekend windows. So in plain English, this is the financial exposure that occurs when the price of an asset moves dramatically, but you're completely locked out of adjusting your protective hedges. When the exchange finally reopens on Sunday evening, the resulting flood of delayed institutional reactions reliably triggers massive Monday morning volatility shocks. But once the new continuous trading schedule activates in late May, this specific structural artifact will cease to exist. There will never be another traditional weekend gap formed on the institutional futures chart because the market will simply never close. However, examining the exact operational mechanics of this continuous trading environment reveals a bureaucratic absurdity. Despite the front-end trading interface remaining active throughout the entire weekend, any trades executed between Friday evening and Sunday evening will officially carry the next business day's trade date. The clearing, settlement, and regulatory reporting for those weekend trades will still be processed on the following Monday according to traditional banking schedules. Because nothing screams cutting-edge financial innovation quite like a global decentralized market being forced to wait for a traditional bank teller to clock in after the weekend. Now, to address this glaring settlement friction, the CME is actively collaborating with Google Cloud to use their universal ledger infrastructure. This ambitious tokenized cash initiative is designed to enable real-time margin calls and instantaneous settlement, with Bank of Montreal serving as the first legacy institution on the platform. Furthermore, their Chief Executive Officer, Terry Duffy, has openly confirmed that the exchange is exploring the creation of a proprietary digital token, specifically for derivatives collateral management. He emphasized that as the systematically important financial institution, their proprietary token would offer superior trust compared to decentralized alternatives. And of course, we should absolutely trust the largest legacy financial institutions to build our decentralized future, because they have always prioritized the financial sovereignty of the working class, right? And by the way, tracking these massive institutional infrastructure upgrades before they fundamentally alter the macroeconomic landscape is exactly why you need the Coin Bureau Telegram channel. This is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates regarding these global regulatory shifts. So please make sure that you secure your informational advantage today by clicking the link in the description below or by scanning the QR code currently displayed on your screen. Now, the transition to continuous trading is only the first layer of this massive institutional expansion strategy. Pending regulatory approval from the Commodities Futures Trading Commission, the exchange is simultaneously launching new futures contracts for Avalanche and SUI on May 4th. These new offerings will include both standard and micro-sized contracts that are entirely cash settled against their respective institutional reference rates. While the CME has not explicitly published their selection criteria, these two specific digital assets clearly meet the required market cap thresholds and already possess established pricing benchmark infrastructure. Now, many optimistic investors assume that securing a regulated futures listing on the world's largest derivatives exchange is an exclusively bullish catalyst for any altcoin. But this assumption is largely based on the historical precedent established when Ethereum futures were launched back in February of 2021. Following that specific institutional integration, the underlying asset experienced a massive price appreciation that ultimately culminated in a record-breaking all-time high later that same year. More recently, the Solana spot-quoted futures contracts that launched in December of 2025 managed to accumulate $1 billion in open interest within just 5 months. That incredibly rapid adoption metric actually outpaced the institutional uptake speed of both Bitcoin and Ethereum during their respective launch windows. However, the fundamental structural flaw with this optimistic perspective is that it completely ignores the reality of synthetic paper supply. Because these institutional derivatives are entirely cash settled, a massive macro hedge fund will be able to establish a dominant short position against Avalanche or SUI without ever needing to borrow the actual underlying tokens. This introduces an unlimited amount of synthetic supply into the market that can aggressively suppress price discovery occurring on decentralized venues. So institutional participants are granted the ability to extract massive financial value from the volatility of these networks without actually contributing any tangible liquidity to the underlying blockchain ecosystem. This creates a parallel financial architecture where TradFi dictates the price of a digital asset while remaining completely insulated from the actual technology. And this dynamic perfectly illustrates the broad existential threat currently facing the entire crypto industry as it becomes increasingly intertwined with legacy infrastructure. We are currently witnessing the aggressive and methodical absorption of digital assets into the traditional financial system. During the first quarter of 2026, the BlackRock Spot Bitcoin ETF was consistently handling between $16 and $18 billion in daily trading volume. That daily institutional flow is more than double the volume processed by the largest centralized crypto exchange in the United States. Furthermore, global spot ETFs absorbed an astonishing $18 billion in net inflows during the first quarter of 2026 alone. Institutional ownership of these specific investment vehicles reached 38% by the end of 2025, representing a massive consolidation of digital wealth by legacy asset managers. This institutional capture accelerated even further when Morgan Stanley launched the very first bank-issued spot Bitcoin product on April 8th with an aggressively low fee structure. And as these traditional investment vehicles continue to dominate the market, the underlying liquidity profile of the entire asset class is changing. Prior to the approval of these institutional products, digital asset trading volume was relatively evenly distributed across global time zones. Today, the vast majority of market liquidity is heavily concentrated during standard US stock market operating hours. The implementation of continuous 24/7 trading on the world's largest derivatives exchange is simply the next logical step in this comprehensive institutional takeover. So by eliminating the weakened blackout window, TradFi is effectively neutralizing the last remaining structural advantage held by offshore perpetual exchanges and DeFi protocol. The legacy financial system is actively building out the necessary infrastructure to monopolize the price discovery layer of the entire crypto market. Centralized institutions are systematically stripping away the revolutionary foundational ethos of cryptocurrency and repackaging it as just another alternative investment class. The reality is that as more institutional capital flows through regulated TradFi rails, the original vision of a purely peer-to-peer electronic cash system becomes increasingly marginalized. The massive macroeconomic landscape is shifting rapidly, and the traditional banking cartel is determined to ensure that they maintain absolute control over the fiat liquidity gateways. On one hand, the expansion of continuous institutional trading provides undeniable legitimacy and significantly deeper liquidity for the broader digital asset ecosystem. But on the other hand, though, this aggressive institutional integration threatens to permanently transform decentralized networks into highly regulated appendages of the legacy financial system. So the boundary between traditional finance and cryptocurrency has not simply blurred over the past year, it has effectively been dissolved by these massive infrastructure upgrades. Crypto has lost a big chunk of its soul. But what do you think? Will these regulated futures contracts ultimately stabilize the market, or are they simply a mechanism for legacy institutions to suppress decentralized price discovery? Please let me know your thoughts in the comments below. And if you want to understand exactly how major asset managers are using tokenized treasury funds to extract yield from decentralized networks, then you should definitely check out our deep dive video right over here. Thank you all so much for watching, and I'll see you again very soon. This is DC signing off.